The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Thank you all so much for joining us today for our quarterly webinar series titled CIO's Corner, Quarterly Update with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth Capital Management. I have been with SCM for 3 years, and my primary role includes client service, marketing, and compliance. I am happy to assist Chris this year with his quarterly update webinars. I would like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of them and will ask Chris to answer as many as he can at the end of the webinar. If we do run low on time and are unable to get to your question, Chris or myself will reach out to you directly after to make sure we get your question answered. Now I would like to introduce our speaker for today. Chris is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, for that wonderful introduction, and thank you all for joining us today. Welcome to second quarter 2018 CIO Corner. Before we get started, just want to, as a reminder, our CIO Corner, along with all our webinars, are open to one and all. So if you know of any friends or family who may benefit from our work, please feel free to invite them to any or all of our upcoming webinars. The schedule and registration can be found on our website, www.stonehearthcapital.com. In addition to the webinars, we have a ton of useful information on our site, and I strongly encourage you all to kind of check it out. So with that, let's get started and review the second quarter 2018. A little technical difficulty there, but we're all set. So let's go over what we're going to cover today. As always, we'll start with asset class performance, what happened in the past quarter, look at a little bit longer term, and look at a little bit year-to-date information. And what it's going to show is that we really saw a narrowing of the leadership and a lot of weakness across lots of parts of the financial markets. So again, the leadership was very narrow. And a lot of this weakness was really due to what we call the 3 Ts: Trump, tariffs, and trade wars. And we'll see how that's reflecting investor sentiment. Then we're going to go look at the current investment environment and how we look at the risk levels in the market. And really this investment environment is really being driven by two different but similar competing themes. There's this increasing rhetoric and lots of noise surrounding trade wars, tariffs, Trump. But the rhetoric really isn't translating through to the hard data. We're really seeing the hard economic data and the signals we're looking at really come in strong. So the data is not matching the negative rhetoric yet. That could change, but we haven't seen that happen yet. And we'll kind of go through some indicators we're looking at that show that. Then, as always, we'll look at portfolio positioning. And it really was unchanged during the past quarter. Again, as we see long-term value in the asset classes we are overweight, like international, emerging markets, alternatives. And then also, while the recent data is not pointing to an increasing elevated level of risk from the previous quarter, we do see some potential weakness in certain asset classes that we are underweight, specifically large cap growth in the US equity market and some traditional fixed income. So with that, let's take a look at what happened in the quarter. So as we're looking at here, as you can see on your screen, is Q2 performance, month end June 2018, so the past 3 months. First thing that sticks out right away, you see oil led the way, the clear winner, up almost 15% in the quarter. This was really driven more by supply than demand concerns. We had a lot of global tensions about the Iran deal, a lot of trouble in the Middle East. We had a strong dollar during the quarter. You can see right here that the dollar rose almost 6%. And really what happens, oil is priced in the dollars across the world. So as dollar rises, oil becomes more expensive for any other country that doesn't use the dollar as their currency. So that has an upward bias momentum hitting the oil prices. We do not think this is sustainable. We do think oil is going to be very volatile. You're going to see lots of large movements up. You're also going to see a lot of large movements down. We do think longer term that trend is really down. But given all the rhetoric we saw in the quarter, it really hit the green assets, what we're looking at in the green assets here, and these are representative of international markets. So international developed was down almost a little over 1%, and emerging markets and frontier were really hit very hard by the rhetoric. We're not seeing the data come through yet, but a lot of the rhetoric. In the US, it was really led by a small cap. And again, as you're going to hear throughout this presentation, it really was this 3 T's, the rhetoric out there about the trade wars. As investors think small caps are a little bit more insulated from any potential trade war and tariffs that may happen. We also saw the S&P rise for the quarter, up almost 3.5%. This is really a very misleading number, and I'm going to show you some slides that kind of show that we really saw a very narrowing of the leadership. So even though the S&P 500 was actually up, the majority of the US market really didn't follow through. It really was just a headline number. And we'll talk about this in much greater detail in a few minutes. So this rally that we saw in the Q2 performance was really very narrow and very bifurcated, with a few assets in the top end really performing well, while the majority of the asset classes really struggled in the quarter. So this is the exact reason we use a multiple lens approach in evaluating markets. We don't want to get blinded by one data point. And we always try at Stonehearth to separate the signal from the noise. So looking at a bit of a longer performance on the year to date, again, you see oil still the outlier, up almost 25% in the year to date, led by the second quarter rally. But overall, this performance is generally skewed negatively to the right. You can see that majority of the asset classes really struggled on a year-to-date basis. One thing I want to point out here, if you really look at these red bars, these are diversified portfolios in the marketplace. So we use iShares ETFs. They trade in the market every day. And typical aggressive client, not a client of Stonehearth, a typical aggressively positioned investor, is down almost 50 basis points. A conservative is down 1. So in this really narrow leadership market, it really was a struggle for any diversified portfolio to post positive returns. You know, we do use weather analogies a lot here at Stonehearth, and this presentation would be no different. So if you've heard me speak lately, I really talk about the difference between thunderstorms and hurricanes and how that relates to the market. And really when we talk about thunderstorms, which we've all experienced here, especially living in New England, is it gets dark, it gets scary, it's very noisy, they pass through, but it leaves no lasting damage. Everything's fine once it passes. There's no permanent damage. While a hurricane is also loud, scary, and noisy, but it knocks down trees, knocks down power wires, you know, could knock down structures. You see long-lasting permanent damage. And we really believe the data points we're seeing and the recent performance is more representative of a thunderstorm and not a hurricane. So with that, let's take a look at the data that is influencing this long-term outlook we have at Stonehearth. So I mentioned this narrowing of the leadership of the market. So what does that mean? How is that represented in the data? So what we're looking at here is a chart from Goldman Sachs. And what we're looking at is the top 10 performing stocks on a year-to-date basis as of June 30th, 2018. So familiar names, Amazon, Microsoft, Apple, Netflix, they're all in the S&P 500. The one thing that really sticks out, if you look over here at the bottom right, there's 122% contribution to the S&P 500's performance. So what does that mean? It means that over 100% of the performance came from just 10 stocks. So if you actually remove these stocks from the benchmark, disregard their performance, the S&P was actually down for the year. So that's what we talk about when we really look at this narrowing of the leadership, and it's really being driven by a few high growth, high momentum, what we consider mostly overvalued stocks in the marketplace. So again, if you did not hold these 10 stocks and you held the US equity market, you pretty much had negative returns on a year-to-date basis. Another way we look at the markets is through factor lens. You know, we can look at individual stocks, we can look at sectors, but we really believe in factors. And factors are just really characteristics of individual stocks. We're looking at a chart here from Style Analytics, and they break the market up into characteristics. Is the stock cheap? Does the stock trading cheaper on its price compared to cash flow? That's a value stock. Is it have a high dividend? That's a high yielding stock. Has it exhibited growth in the past? Not in the future, in the past, that's a growth stock. Quality, stable profit margins, stable earnings, quality stock, size, small, volatility, self-explanatory, highly volatile stock, and momentum. So again, what this is showing on a 3-month basis is just the past quarter as of 6/30. It really shows a bifurcated market with just a tiny, tiny sliver of the market showing positive performance, with the majority of the market either flat or negative. And you can see that where we have this big value relative to the market, excuse me, negative performance here. Sorry. And the growth really outperforming. So what this is saying is that the market is really being driven by one characteristic, growth. We do not think that is sustainable in the long term. And history has shown that as the market narrows and you really see that concentration of performance, investors tend to get burned over the long term. So all of this is one of the major concerns we have with the U.S. equity market. It's the historically narrow leadership has led to reduced future returns in the market. As we say here, markets are always stronger when the upswing is broad. And what we're trying to do is really try to find the signal through the noise. So when we look at this chart, we look at the previous chart, looking at the S&P and the U.S. equity market, what's the noise? The noise is the S&P 500 headline number was positive for the quarter, excuse me, on a year-to-date basis. What's the signal? What's the information that really matters, that really should be impacting portfolios? The majority of the stocks were either flat to negative. So that's what we attempt to do and try to find the signal through the noise. So now we're going to take a little bit longer term, but again, we saw that growth factor, we saw that value factor. This just is another representation of that. A little bit longer term, it's on a 1-year basis. And what we're looking at here is 2 different ETFs generated by Russell. They had the IWF represented by the red line, which is growth stocks. The blue line right here is value stocks. And they basically just take the top 1,000 stocks in the US market, split them into growth, value, and create an ETF. And we can track that performance. And what this shows, like we've seen in the other charts, is this big widening gap, this trend difference between this tiny sliver of the market and the more general market. So this really clearly shows that growth is in charge. You know, one of the themes here is we do not think this is sustainable, as we believe in mean reversion. It's alive and well in financial markets. And as we look over longer term, we believe this gap will narrow and, you know, eventually close. And throughout history, we've seen this happen over and over again in multiple asset classes, multiple factors. You know, there will be a time to own those growth stocks, those Amazons, those Facebooks, but not at these levels. And in my opinion, value offers the better risk-reward trade-off going forward. So we've talked about this narrowing of the market. We talked about the U.S. equity, the S&P 500. Now we're going to kind of switch gears here and take a look at the data we are watching, which helps us frame the current risk environment. Again, trying to find the signal through the noise. So this is a chart from JP Morgan on global trade. I had to include it because, again, when we start talking about the 3 T's and the impact we're having, it's really concerning global trade and the impact it's going to have on growth going forward if these tariffs are implemented. And that is the real signal through the noise here, if. So what we've had so far is $34 billion of tariffs implemented. If you think about it, with the GDP, US GDP of $19 trillion, that $34 billion represents less than 50 basis points. We have threatened another $200 billion in tariffs, still under review, still have about 3 months before we actually implement that. And that's only around 1% of GDP, and it really is under review. So what we're looking at here is the world trade volume, the growth. You can see that historically it's averaged right around 5%, and we hit that just recently at the end of 2017, beginning of 2018. And we did see a little bit fall off. So it did fall off a little bit. It's growing about 3.8. Again, slowdown doesn't equal falling off a cliff. We can see a slowdown in growth. 3.8% is still decent enough growth to support the risk assets that are out there. So again, concern, yes. Rhetoric, while scary, thunderstorm, does not match reality yet. We're still seeing good global trade volume. We're still seeing good global growth around there. So we're seeing a slowdown in growth, not an actual slowdown. The noise is crowding out the signal. The other part of this chart is exports as share of GDP, and this is just more for interesting point of view than anything else. It's funny. So looking at share of GDP by exports, and what countries are we mad at, you know, from a political point of view right now, and what's going to be the biggest impact. We look at the biggest traders as a percent of GDP, Taiwan, South Africa, Korea. You really don't hear about them. Mexico, yes. Russia, and China. And then we also start looking around about the impacts about the US. So if you look at China right here, it's less than 10% on the US. We sometimes forget that when we look at the headline numbers and don't dig into the data. This may not have as big as impact as a lot of investors think it will. Now, it will impact sentiment, but again, it does not have to translate into a slowdown. It's a very small piece. And you can see China trades a lot more with Asia. So even if there is a so-called trade war, which we don't think there will be, we think cooler heads will prevail, what is the actual impact to asset classes? It may not be as bad as people think. Again, we'll let the data kind of drive that decision process, but as we're looking right now, we see the data, we don't see it impacting it in a meaningful way yet. So let's turn to volatility, another theme we've been talking about a lot here at Stonehearth Capital, and if you've heard me speak, we're always talking about this return of volatility. What does that mean? Well, what we're looking at here is a chart of the number of days in calendar year when the S&P 500 dropped by more than 1%. So it's a good indication of volatility in the market. How volatile is the market? And you see going back to 1970 that it's been very volatile. We expect that. It's a high risk asset class. It generates excess returns. You have to deal with some volatility. When we look at right here, this 4 number, that was 2017. So through all 2017, there are only 4 days where the S&P dropped by more than 1%. We look at year to date 2018, it's been 16. So we feel that change. We're like, well, this is big sea change in terms of volatility. Taking a longer term view, we look back. What we're experiencing in 2018 is close to what we've experienced in history. So what is really the outlier? Is it this volatility we experienced in 2018, or is it what we experienced in 2017? I really think what we've experienced in 2017 was the outlier, and we fully expect the volatility to continue. And just like a thunderstorm, volatility can be scary when you're in the middle of it, but once it passes, you see that there was no permanent damage to your portfolio. And we really expect this volatility to continue to pick up as 2018 winds down here, but it will have very little long-term impact on your portfolio. We will see many fits and starts, up 1%, down 1%, but in general, we don't see a long-term impact to your portfolio. So another theme we're talking about lately is inflation. So where is inflation? You hear a lot in the press about we don't see inflation, where's it coming? Well, we're starting to see a pickup in inflation. And what we're looking at here is a long-term chart. CPI, Consumer Price Index, that's how all economists, that's how the numbers are reported. When you hear inflation, they use the CPI, which is a government-generated number. So this headline CPI is this light blue number. Now, if you take out food and energy, which I'm not sure why, because everybody has to fill up their cars, everybody has to heat their house, everybody has to eat, it smooths out the numbers and you get that brown line. But we're going to focus on this blue line right here. And what it's showing is upwards and to the right. So again, we're starting to see inflation pick up. Not back to the 1980s, the 12, 15%, which I don't remember, but I have studied in the history books. I can't imagine having prices rise 12, 15% in a year. But it is going upwards and to the right. And you can see the short-term history here is we haven't experienced high inflation in here in a while. We really haven't beat the averages since almost 2007, 2008. Investors tend to have very short-term memories, and they tend to focus on the recent past, and they focus right here and say this is abnormal. This is not abnormal. We see inflation coming. We think this continues. We'll have to let the data roll out, but we really see this really going up and having a meaningful impact on a lot of assets. And as inflation rises here, consumers may really begin to actually feel this effects. They haven't experienced inflation in any meaningful way for a long time. So what we really see with inflation is the biggest impact other in clients and consumers' pocketbooks is it has an impact on fixed income assets and yield producing securities, those high yielding assets. And you see as one of the biggest question marks as 2018 rolls on is, does this rise continue? And if so, how would it influence the Fed? Because the Fed has a dual mandate and it reacts. Remember, the Fed has a dual mandate. No matter how absurd the concept seems, it has a maximum employment and stable prices. What do they mean by stable prices? They look at CPI and they like it right around 2%, and they don't like it rising or falling. They like its stability. So again, that would be the biggest question as we roll out in 2018. We really expect this rise to continue, but we are well positioned within our fixed income portfolio to handle this rise. And as you see when we get to the portfolio positioning portion of the presentation, sneak preview, it's more about where you are positioned in the fixed income market than how much you have allocated to it. So speaking of the fixed income market, let's move on to the yield curve and try to find the signal through the noise. So what we're looking at here is the yield curve. I'm sure we've all heard in the press about the yield curve. I'm not sure not many people actually look at the actual yield curve. So what a yield curve is really simple, is it's different lending rates at different terms. So to lend to the US government for 1 month, currently, which is this tan line right here, you would expect to earn 1.75% income. 3 months, 1.92, and so forth. You lend for 2 years, you get 2.5. Makes sense. If I lend longer, I expect a higher rate of return. So that's why when we see the yield curve upward and sloping to the right, that's normal. What's a little bit different here and what's looking strange is we see that the rate rise that we've seen recently from the Fed is really impacting the shorter end of the curve. The change is much larger here than in the longer end of the curve. So outside influences is more of a demand function than a signal about the economy when we look at this longer term, 30 years. So why are we seeing no movement on the long end? It's resulting in a flatter yield curve, and historically this has been a sign of future weakness. Again, curves flatten when the short end goes up higher than the long end. And this is very concerning, but we have a lot of outside influences we are seeing in the market right now, and it makes it more noise than a signal. We have a lot of forced buyers on the long end of the curve. There's a mandate out there that a lot of companies have to own AAA rated bonds. Well, when we look around the world, there aren't too many AAA rated bonds anymore. I mean, one of the biggest issues was GE, and they're far from a AAA rated anymore. So they have a mandate to own AAA rated bonds. Where do you find those? Pretty much only in the US. So they're a forced purchaser. And given the current low state of absolute yields, there really is no yield out there. So they're really trying to generate some kind of return, and what that means is heading out to the long term. So we do expect this long end to really start to begin up to the movements and catch up to as a short end, and we do not see a negative slope to the yield curve coming. Keeping with the yield curve, looking at a longer term view, we kind of want to show what a more normal yield curve is, because I think investors hear yield curve, hear slopes, hear changing, they don't really understand what's happening. So when we look right here, there's a great chart by JP Morgan that kind of helps explain it, and kind of keeps it simple. Is this called brown line right here, December 31st, 2013, is a more normal sloping yield curve. If I lend 1 year back in 2013, I get 0.1%, which is really low on an absolute basis. 1.8 for 5 years, 2.5 for 7, increasing to if I lend out 30, I get 4. We go to current day and we see the big difference here, where 1 years are up a lot, 2.3. Again, as the Fed's raising rates, we see that. But look at the long end. It really hasn't moved upwards. So that's why we're saying we're not in a normal yield curve environment. So again, we really want to see this curve come back to this normal, because we would expect in a high growing economy that you would expect a higher return lending. So this shape of the yield curve will have an outside influence on investor behavior as we move forward in 2018. One follow-up from this as we look here is that cash, and what we consider cash, short-term lending 1 year at 2.3%, it may look like a viable investment option again. I mean, for a long time, investing 1 year at 0.1%, you don't even beat inflation. Now it's kind of looking a little bit more attractive. I wouldn't be moving assets into cash yet, but at least we're starting to get some sort of return from holding cash. This makes reducing risk in a portfolio a little bit easier when you can earn a little 2% in cash when the time comes, but now is not the time, as our risk model will show. So let's move on to the strongest signal we're really seeing in the markets, the macroeconomic backdrop. So what we're looking at here is PMI indices. So what is a PMI indice? It's a diffusion index. So it's really reflecting the current environment and expectations for the future, and which is really what we're trying to find when we talk about the signal to the noise. We really want to know what's going on in the future. So what happens, governments ask a series of questions to purchasing managers, people really in the know who are in the weeds ordering durable goods for their companies, and they ask a series of questions, and all they want from the PMI people is it getting worse, staying the same, getting better? If that outcome is greater than 50, which means more people saying getting better or staying the same, then we consider that economy in an expansion mode. And the color code here is that if it's greater than 50, it's in green. So what are we seeing here? If you look at the signal, if you look at the color codes, you can see from the chart, it's a sea of green around the globe. There's a few pockets, Russia's a little bit under, but still, very healthy. Korea at 48. But in general, global growth is increasing. Economies are in expansion mode. Again, what's the noise? Global trade rhetoric. Everybody's fighting with each other. What's the signal? The economy is strong, and purchasing managers around the world, those who are in the know, see it continuing. So again, in trying to find the signals in the noise, some investors try to make things a little bit more difficult than they are in real life. Again, we can throw bunches of data points, but sometimes you just got to keep it simple. And I love this chart for its powerful and its simplicity. What are we looking at here? Wages on this blue line. Wages are going up. Looking at unemployment. Unemployment's going down. Think about the equation. Wages going up, unemployment going down, good economy, and good for the future of the economy. That's it. The KISS principle, keep it simple, and I'll let you fill in the blanks on the last word. Really is showing that the economy is still moving along and still growing. Another way to look at the economy is through the ECRI Weekly Leading Index. ECRI is a component of 10 different indicators that historically have foreshadowed slowdowns in the business cycle. And you can see it's been a pretty good indicator. You look back in 1968, see it kind of coming down negative, and you see a recession starting, which is by these shaded lines. 74, same thing. 1990, same thing. 2000, same thing. Really big drop off and the financial crisis. When we look at it today, we really don't see this drop off. We don't see a weakening in these leading indices, these historical data points that have shown before that may foreshadow recessions. Not an absolute predictor. We have to look at multiple signals. But the data or signal from the leading indicators is that the business cycle continues to be in expansion mode. So having looked at some of this economic data out there, let's turn to the bigger picture and combine all the factors we use in judging the underlying health of the market. And again, as always, trying to find the signal through the noise. What is our multiple lens internal risk model telling us? Well, really what it's telling us, things are good, not great. We can live with that, especially with a diversified portfolio. It doesn't have to be going like gangbusters, even though we would love it to. That would definitely help a lot. But if things are still good and continue to be good, then we see the benefits of holding risk assets in your portfolio. We do see risk is increasing a little bit, but not enough to make any changes to our long-term asset allocation. So every quarter, I show this on this webinar. And we look back here, 3/31/2018, we can see the technical picture, the structure, the reversion, and a little description of kind of what we describe those as down here, is basically was neutral to flat. So I'm not really giving a signal, not a lot of information from the technical piece of the market. And that is really a good point. When we're looking at it, a neutral doesn't really mean a lot. It just means that there's not a lot of information from that signal at that given time. When it's positive, we have positive signal. Negative signal. Neutral just means we don't have a lot of information. As you see going through the quarter, we actually turned positive as of June. So the technical structure, the big driver of the positive was that we saw some small caps start to outperform large caps. Again, we talked about that earlier. What was the outside influence of that? Is it telling us that the market's getting better? Or is it just investors realizing that there may be a trade war and we want to get into an asset class that we think will be hurt less? We think it's the latter, not the former. The reversion metric also increased throughout the quarter to a +1. And that was really driven by a momentum indicator as it turned positive. But a momentum indicator is based on the S&P 500 index, which we saw from our previous slides is really not reflective of what's going on in the broader market. So all in all, we did see a positive move in that technical structure. We think it's more noise than signal. So let's look at our other factors and see what it can tell us about the picture. We look at valuation. It's flat for the quarter, still very negative, still hard to find those value stocks in there. The market is definitely overvalued, but there are pockets where we can see that they're less overvalued or even undervalued, and we take advantage of those. Macroeconomic, still positive. We saw a small decline, really driven by a weakness in copper prices. They always say in the market that copper has a PhD in economics. It really drives beginning stages of weakness. You really see it there first. But again, something to be concerned about, but looking at the overall economic picture and the other data points we use, we still see a very positive economic environment. Qualitative stayed the same. We still have the same risk environment. There's still a lot of rhetoric around the trade wars. The Fed is still in a rising mode, but overall, it's still a situation that's very conducive to positive performance. So changes during the quarter we saw, and they were more noise than signal. So before we move on to portfolio positioning, I really want to highlight a few indicators in our model. Not that any one indicator is more important than another, but I just want to give you a flavor each quarter of what we are analyzing here at Stonehearth and how we analyze the amount of risk we are observing in the marketplace. So we talk a lot about this narrowing of the performance in the S&P 500 and the US equity market. And this is showing up in our model too. So we're picking up this concern in the marketplace. And what we're looking at here is the New York Stock, all stocks listed in the New York Stock Exchange, and are they above or below the 200-day moving average? In simple terms, what does that mean? Stocks in an uptrend or a downtrend. So out of all the stocks in the New York Stock Exchange, what this data is telling us is that 53% of them are in an uptrend. We like to see that really above 60, and we like to see it straight or going up. And we can see that we're starting to see some weakness, and that's really reflecting that narrowness of the US equity performance. Now, again, it's not too bad yet. It's not back in beginning of 2016 when we saw like under 20% in downtrends. But again, a cause for concern. We do think this is something that's going to play out over time in the US equity market, that where investors could get burned by really focusing on that headline number too much and saying, hey, the S&P is up 3%, everything's great. But when you look under the hood, it may not be so great. Again, one indicator pointing to a negative. Turn to the macroeconomic environment, some of the indicators we use in our economic model. And what we're looking at here is a new orders of non-defense capital goods, excluding aircraft, because aircraft that cost billions of dollars, they really skew this number, so we take those out. And what we're looking at is a year-over-year change of a 3-month average of companies ordering capital goods, goods meant to last a long time. Historically, this has been a good indicator of future production, which is the main component of future growth. They are seeing demand. So when companies order, and they order capital goods, they don't order it just because they want to. They order it because they see demand coming in. They need to replenish their inventories. They see consumers buying things, and this is very strong. So what we'd be concerned about if we saw some weakness is going negative, which means they're ordering less than they did a year ago. So right now, we saw a little downturn, which is fine, just more noise than signal, but still a very healthy, growing 6% year over year on a 3-month smoothing average. It is a very strong indicator of a very healthy economy. Jobs, again, we talked about the KISS principle, and keep it simple. And again, I'll let you insert the last word. And we're looking at here a 3-month average of jobs created in the US. Again, smooth average, so any one data point doesn't have an outsized influence on the indicator. And it's very, very tough to have a recession when job growth is positive. And we're seeing very strong job growth. May not be the exact jobs we want, but economies are constantly changing in creative destruction. And in essence, what the indicator is telling us, and the keep it simple principle, is that jobs are being created. What does that mean? Very simple. More jobs, more money equals more consumption. Consumption is around 70% of GDP. So if we still see jobs growth, we don't see a slowdown, we don't see negative, then we would still expect consumers to have more money in their pockets, feel better about their financial situation, which leads to more consumption, which leads to more GDP growth, which leads to a healthy economy. So that's kind of how we're looking at in terms of the current risk environment. Now we're going to kind of move to portfolio positioning. So again, like I stated earlier, there really was no change from last quarter to the overall asset allocation. We did make a small change in exposures for our more aggressive portfolios. We did swap some US exposure for some small cap international. And again, I'll go over some charts to see why that makes sense in this world, but we did not change the overall asset allocation makeup. It's just swapping one risk asset for another. We're finding better value in international. So as equities in total, we are neutral. So we're not overweight or underweight. We definitely think where you get exposure matters. And we're underweight the US. Again, we saw the narrowing of that performance, even though the headline index showed positive US equity performance, the broader US equity market was actually negative. International developed and emerging markets, we're overweight. We think they still make long-term sense. Again, you're going to have some volatility, some fits and starts here due to the increased rhetoric, but no long-term lasting damage to the overall thesis on international developed and emerging markets. Fixed income, we definitely want to be underweight as the Fed continues to raise rates here. We think it's going to hurt traditional fixed income portfolios. And like I said earlier, it really matters where you get your fixed income exposure, not so much how much you have. Pretty neutral on cash, but again, skewing towards more positive. As we've seen those short-term rates rise, you can earn a little bit more, but we still don't see a lot of benefit for clients to holding excess cash right now. Commodities, we're underweight. We continue to be underweight. We don't like the long-term fundamentals of all the commodities out there that we can get exposure to, and especially when we look at oil. It's going to be volatile. You're going to see headlines about it, but I do think looking longer term in an economy that is rapidly decarbonizing, looking out, oil is not a viable investment thesis right now. And as always, we want to be overweight alternatives given the current environment, our low expectations of returns going forward for asset classes. We really think investors benefit from a healthy dose of alternative asset classes. And again, remember, what is an alternative asset class in Stonehearth? It's any asset class whose returns do not rely on an equity or fixed income market or commodity market to go up. Doesn't mean they don't use those instruments in terms of to generate their return streams. It just means that they don't have to go up. So if you look at like the US equity market and you look at the S&P 500, it needs an equity market rising to generate any return. An alternative asset class could have the market go down and still generate a positive return. Doesn't mean they always do when the market goes down, but it just means they have the opportunity to generate returns regardless of the direction of equities and fixed income. So let's look at a few charts, a few individual asset classes here and why we positioned where we are. So what we're looking at here is why we're positioned international over US. What we're looking at here is this gray line right here is the S&P 500 index. You can see the characteristics right here. And ACWI, ex-US. What's ACWI? All Country World Index. Every country in the world. And then they just take out the US. So you can think about this, the split right here is the brown line, US only, the purple line, everything else. And what we're seeing here and what this line represents is a PE. So what does a PE mean? It means price earnings, and it means how much is an investor paying for $1 of earnings. And it's a good judge of a valuation state of a market. So you can see that we're paying 16.1 times for the S&P 500 exposure. You're only paying 13 times for international exposure. On an absolute basis, it doesn't matter. When you start comparing to a relative basis and you look at the better demographics internationally, the better growth prospects, and historically where it's traded, that it has, international has historically traded cheaper than the US, but not with this gap. This gap is very wide. So again, we believe in mean reversion. We believe this gap is going to close. We believe that you're better positioned to have an overweight to international and an underweight to US. Doesn't mean zero in the US because the US can still perform from here, but we do think this gap closes. International outperforms the US, which is why we're overweight international assets and underweight US. And then when I look at it from a portfolio perspective, if we're really seeing risk increasing in the market, why would I want to own the more expensive asset? You want to give out, holding the less expensive asset, it has less to fall than less expensive assets in any type of market decline. So it gives us a larger margin of safety in our portfolios against any potential short-term market declines. So let's turn our attention to the fixed income market. Again, we talked about how we're underweight, and I gave you the sneak preview that, the really importance about where you're taking risk in the fixed income market. I mean, this exhibit from JP Morgan clearly shows why that matters. So what we're looking at here is long-term rates. You can see US Treasuries, different fixed incomes, the returns, yield. I can let you go through that on a later date if you want. What we really want to concern ourselves with is this chart right here. So we talk a lot about duration. And again, I think in the keep it simple, insert your own word here, principle, we tend to make things more difficult when we talk about duration. What is duration? What it is a calculation of a asset class's sensitivity to a 1% rise in interest rates. What does that mean? A duration of 6 means if interest rates rise 1% across the curve, then you would lose 6% in that asset class, all else being equal. That's all it means. So what this gives you good judges is how sensitive it is when Feds raise rates, what's going to happen to that asset class. Again, looking at this chart, left is negative, right is positive, and you can see that if you're holding any type of US Treasuries, you do not benefit when the Fed raises rates. You actually hurt a lot. And the longer duration asset you hold, the 30-year, the worse it is. We look at other parts of the market. We look at the aggregate. So that's the entire traditional, what we call traditional fixed income. You can see it's going to get hurt a lot. The total return is almost negative 3% if the Fed raises rates by 1%, which we fully expect them to do. IG corporates, munis, all the same. Then you look at parts of the market that may benefit from a Fed raising rates. Look at floating rate, things that adjust every 3 months. So as the Fed raises rates, that coupon adjusts. We look at some convertibles, which we have a very healthy exposure to in our conservative client base. You can see where it actually benefits from a rate rise. We also hold a big piece in strategic income portfolios, the ones who can manage duration along the curve and actually have that duration closer to negative than positive. So again, where you have fixed income exposure really matters. So we are underweight duration across our portfolios, as we fully expect rates and inflation are headed higher and probably quicker than investors expect. And this could lead to large dislocation, think hurricanes in the traditional fixed income asset classes, like treasuries and the broad bond index. We don't think that serves investors' portfolios very well. The last piece we're going to look at is alternatives. And we're going to look at alternatives through the lens of managed futures. There are different alternative asset classes out there, but we have a large exposure to managed futures. And why do we have that? So what we're looking here is historical chart put together by Credit Suisse. And what they're showing is throughout history, certain drawdowns in certain asset classes. You have global equities right here, global high yield bonds in the real estate market, which is the publicly traded real estate market, not individual real estate, and commodities. So you can see May 08 to November 08, global equities fell 40%. What did managed futures do? They were up 7%. Pick another one, December 8th, February 9th, the market was down 18%, they were only down 1%. Look at this global high yield bonds protect you in these downdrafts. May 08 to November 08, high yield was down 33%, managed futures was up 7%. Look at the commodities, they were down 68%, huge drawdown, managed futures were up. Real estate, same picture. So again, we do know historical performance is no predictor of future performance. We do know it's no guarantee, but what we've seen throughout history is that having a good sized exposure to managed futures helps protect you against any of these shocks to the marketplace, things that happen out of nowhere. When markets go down, they can generate a positive return. No guarantee they will, but again, throughout history, this diversification into a different asset class with different return streams has benefited investors by giving you some protection on the downside. Not total protection, but some protection. And while doing this, they should, over the long term, generate a single-digit positive return, which is good because if you think about it, when you talk about protection from downside, you usually talk about paying something. So I can buy some options, cost me some money. I can move to cash, should cost me some return in the long term because cash earns less than other asset classes over the long term. This actually pays you for protection, which is kind of why we like these characteristics. So we haven't seen this benefit yet. Again, why? Haven't seen any large drawdowns in the market. We've seen that lower volatility in 2017. We don't think that can continue forever, that we are going to see some drawdowns, and that having a healthy allocation to managed futures will kind of buffer that drawdown that we see in the marketplace. So let's kind of close out before we get to questions with some final words and final thoughts about what we've talked about today and what we're seeing in the marketplace. So again, the negative rhetoric is not being confirmed by the economic data. We went through the charts. We saw the jobs being created. People are ordering durable long-term goods. We see manufacture increasing. All these data points lead us to believe that it's more of a thunderstorm than a hurricane. So the rhetoric is not matching the data, trying to find the signal to the noise. We do have extended valuations, and we did see a narrowing of the market leadership, and they are a concern. Again, one data point, but again, gives us a little bit negative view on the U.S. equity market going forward here when we see this. Mark's technical picture is weak to neutral, but not broke. We're not seeing any big fall off, not seeing any negative signals. We're just not seeing this big, strong technical signal in the marketplace. But still, overall, just really neutral to slightly positive. You want to pay attention to your risk exposures coming from. We talked about this, especially within the equity markets. We like international over US, given that valuation discrepancy. Same thing with value over growth. We like the valuations of value stocks over growth stocks. We also get nervous when we see hot asset classes with every investor and their sister piling into the growth stocks. So what we've seen historically as investors rush in and kind of buying without thinking, they do the same on when they leave. They sell indiscriminately, and you see those big drawdowns in certain pieces of the market. Inflation rates, they're probably headed higher, and I think quicker than most investors expect. So you want to be cautious in reaching for yield or chasing risk. You know, cautious going out to those long-term treasuries, those high-yielding assets that could be in trouble. You definitely want to be short duration in your fixed income positions. We saw how we can achieve that through some strategic income products, floating rate, bonds. You definitely want to have some inflation hedges in your portfolio besides equities. And given the interest rate picture, given their durations, you really don't think TIPS is the right way to do that. We really like some inflation products that just have a pure 100% inflation hedge embedded in it with no duration. And there's a product from Lord Abbott that we use that we really like for that. So you do want to have some inflation hedges because we do think it's heading higher. We do want to remain overweight alternative asset classes. We don't want to have to be relying on rising equity or bond markets to generate positive returns in clients' portfolios. And as always, try to find the signal through the noise. What is the signal telling us through all the noise? We're experiencing a thunderstorm. No long-lasting permanent damage, but it can be dark and scary when they're happening, but they leave no permanent damage. So again, I want to thank you for listening to my presentation today. I'm going to turn it back over to Amanda, so to see if there's any questions in the queue. I'd be happy to answer as many questions as we can get to today. Amanda?
Hi, Chris. Thanks so much. That was really interesting and a lot of information that I'm sure a lot of people found useful. I do have a couple questions here. The first one is, with everything going on in the world, can I ensure my assets are invested in a way that reflects my concerns?
Good question. Yes, you absolutely can. I really think it begins with having a conversation with your advisor about your concerns. We call this here aligning your financial assets with your personal values here at Stonehearth Capital Management. And it's really about, you know, investing in sustainable, responsible investing assets. It's a conversation I'm having more and more with clients day to day, you know, and as one example, we've done like a lot of work with clients on reducing their carbon footprint of their assets without radically changing their investment portfolio. And it's really driven by the concern from clients that they have about the carbon and the impact in climate change. And again, you have to remember, it is your money. It does what you want to do. You want to align your financial assets with your personal values. I don't think it works well in all cases, but I think the biggest thing I can say is, and the best piece of advice, start the conversation. Talk to your advisor. Ask them about how and can you implement this in your portfolio. I think it's a great conversation to have, and we should be having more of these conversations.
The next one I have here is, given the recent U.S. equity market performance, why shouldn't I move all of my assets into the U.S. market?
Yeah, we get this a lot. Kind of thinking about it, I mean, only if you are 100% sure the next few years will look exactly, and I mean exactly like the past few years. If you're not 100% sure, then I don't think it makes sense. You know, hindsight's 2020. It's easy to manage a portfolio in the rearview mirror and just see what performed well, but we really can't do that because we are managing the portfolio for the future. You know, we are building a diversified portfolio for what most likely lies ahead, not what's happened. So I do think that investors will get burned by holding a highly concentrated portfolio, and I think a diversified portfolio is a much better way to build long-term wealth.
Where is the best place to invest right now?
Best place to invest. Well, we really don't look at the world that way. You know, there is no one best place to invest at any given time. It really more depends on your own goals, your financial strength, and your financial temperament. I mean, think about it this way for an example. Say a just married couple, you know, say in the early 30s walks in, They both have jobs, well-paying jobs, and they have no kids. At the same time, say another couple, maybe in their 70s walks in. They're both retired. They have no pensions. They just have assets in their personal retirement fund. And both of them come in asking the same question. It's easy to see how you would give them two very different answers. I mean, they're both in different situations. Investing in high-risk equity assets doesn't really seem like a good investment for someone who's in their 70s who really needs retirement and income, compared to a married couple who's just starting out and maybe can handle more risk. So again, it really depends on your own unique situation, and that's why I always advise clients. A lot of these questions come from the CNBCs of the world, maybe the talking heads, and where's the best place to invest, and I want to own only this. There is no one size fits all, and as best you can, kind of tune out that noise and really talk to your advisor about what your long-term goals are, how best to achieve them, and less about what's the best investment at any given time, because it's going to be different depending on everybody's situation.
Chris, what data point needs to change in order for SEM to change its outlook?
Yeah, I mean, again, we talk a lot about the data points, and I've shown a few, but there really is no one data point. We use a weight of the evidence approach, with all indicators having the same impact as any other. With the exception of value, we have a double weight to that because we think it matters more. But in general, we want to look at the total picture. I'm always looking at the entire picture through multiple lenses. It helps us remove emotion from the equation, and it prevents blind spots. If you're only focusing on one data point and only one piece of the market, you're missing a whole big picture. There could be a lot going on over here on my right hand. The right hand doesn't know what the left hand is doing. So we really want to look at one total picture and not any one data point. Again, any one data point can move up or down, but we're really looking at the total weight of the evidence when we try to find out how much risk we should be taking in client portfolios. So there really is no one data point. You really have to tell me how all the data points are moving and look at the weight of the evidence approach.
Chris, what is the Fed going to do?
Yes, simple answer, they're raising rates. This is easy. The Fed has very clearly communicated what they're looking at in the decision-making process and how they would judge it. They've continually said what they're going to do, and they've done what they said they were going to do. So I really think the bigger question is not the direction, but more talking about the magnitude. And I do think if this data keeps on its current trajectory, the market could be very well surprised with how fast the Fed can move. So I think they may get more rate hikes, but it's definitely going up. So I do think we're on target to maybe 4 rate hikes over the next year or so, all else being equal. But again, as we rely on the data, the Fed's relying on the data, and we'll see how that all plays out. But I do think rates are headed higher, and that has a big impact on where you take risk exposure in your fixed income asset class.
Hi, Chris. Just for everybody's time here, I think I'm just going to end with this last question, and of course we'll get to everybody else's questions after the webinar. It says, you mentioned risk is increasing multiple times. Why aren't you reducing risk in the portfolio? Excuse me.
Sure. Yeah, you're 100% correct. Risks are rising. But again, we use a model and the weight of the evidence to ascertain how much risk we're taking. And the weight of the evidence right now does not point in that direction. It points to an increased concern. But what we're looking for in our model is that tipping point, when that concern tips to action. We can always be worried about something, but when does that worry turn into something we can actually act upon? And what we call that is that tipping point. In other words, what we're really looking for, and what we've kind of consistently said throughout this presentation is, trying to find that signal. What's the tipping point through all the noise that's out there? And right now, that signal is telling us things are okay, not great. We're good with taking normal risk in our client portfolios.
Chris, I think that's it. I think it's time to wrap up. So thank you so much for all this information.
Thank you, and I look forward to talking to you again next quarter.
Thanks, Chris. Have a great day, everybody.